Good evening, everyone. Thank you so much for joining us on the ECI monthly webinar series. With us tonight, we have a very, very special guest just in time for the upcoming tax season. With us tonight is Vincenzo Villamena. He is from Online Taxman, and Vincenzo and I met a few years ago at the Live and Invest Overseas conference. And taxes, while they can be a
Yep.
pretty tedious subject, they are one that people tend to have a lot of questions on, especially people who are investing outside of the United States of America. We understand that our tax system in the US is one of the most complicated in the world. And as soon as you do anything that deviates internationally or that's just a little bit different, it may be a little difficult to find answers. So Vincenzo was just an absolute star at the conference that we met at, and even the other conferences he's been to. He always seems to have a handful of people around him asking questions, and the reason for that is pretty obvious. Vincenzo knows his stuff. He's very, very well versed in taxes, and he's very well versed in the international forms that you need to fill out when completing your taxes. So we all know April 17th this year is coming up, just a few weeks, and Vincenzo's taking a few minutes from his very, very busy schedule to chat with us about what it is that you need to know, especially if you're somebody who does international business, whether that's international investing or if you live internationally, what that means for your forms. I do want to let you know that we are recording this webinar. You'll receive a copy of it later on this evening as soon as the session ends. So if you have any friends or family who weren't able to make it tonight, then this will be very, very handy for you to send over to them. Another housekeeping item is that we're going to go through questions at the end of the presentation. So in your control panel, you should see easy access to the questions section. And this is where you're going to be typing in your questions. We're going to read them at the end and go through them together. So how the presentation is going to work, Vincenzo is going to give us a little bit about him. He'll talk more about the taxes and the forms and everything you need to know. And then we're going to segue into ECI development, just give you some updates. I know a handful of you have been on our webinars with us the past few months, and we want to keep you updated about what's going on. That'll be about 5-7 minutes. And then from there, we're going to go into the questions and answers section. And that questions and answers can be anything tax related, anything ECI related, whatever it is that you want to ask. We will have Vincenzo on the line with us as well. So make sure that if you have any questions while he's chatting, you're able to just type those there into the question section of the control panel. So without further ado, here is Vincenzo. Vincenzo, thank you so much for joining us this evening. I know it's a little bit later where you are in Colombia, so again, thank you.
No, very welcome, and thank you for having me, and everyone obviously listening in. I'm happy to help answer questions, like I said, at the end, and obviously dismiss anyone's misinformation, and obviously help people make informed decisions and understanding on what it's like to be a U.S. expat and also invest abroad. So with that being said, my name is Vincenzo Villamena. I'm a CPA and the managing partner of a firm called Online Taxman. We focus on expat taxes and for, again, people that invest abroad and have kind of an international flavor to their investment portfolio, and happy to be here. On to the next slide. So I'll go through kind of the agenda, but I think the first question is really just who needs to file, right? And as a U.S. citizen or even green card holder for that matter, people must file a federal tax return if their income meets a certain threshold. And as you can see, that threshold is $10,300 for singles, $20,600 for people married filing jointly, and $4,000 for filing separately. Filing separately could mean that you might have a spouse that's a non-resident or non-American, but you choose to file separately, and we'll get into some of the benefits and pros and cons of that. But if that is the case, then you do have to file a tax return. You might have to file a state return as well, depending on what state you're from and what ties you have, right? So again, if you're from some of the greedier states, some of the aggressive states like California, New Mexico, Virginia, Massachusetts, then even though you live abroad, if you do have any sort of ties like a driver's license or a home, whether you rent it or not, you might still have to file. That's obviously on a state-by-state basis. And again, even if your income might be earned abroad, you might be living and working abroad, but again, as a U.S. citizen, you still need to file your tax return, as well as some other disclosures if you have bank accounts and other investments there. But there are some tax breaks for U.S. citizens living abroad. One is called the Foreign Earned Income Exclusion, and the other one is called the Foreign Tax Credit. The Foreign Earned Income Exclusion really allows expats, people that qualify, to earn up to 100,000 to 102, 100 in tax-free income from income tax, right? And this is something that changes every year. It's really indexed to inflation. So that's the number for 2017. I think 2018 is around 103. And like I said, it does go up every year. There could also be even more exclusion if you pay for high housing expenses, which I'll get into a little later. And you could also, like I said, use the foreign tax credit as an alternative or in conjunction with. But to go to the qualifications, you must qualify for either one, the bona fide residence test, or two, the physical presence test. The bona fide residence test, if I could back up. All right, there you go. The bona fide residence test, again, is really for people that are residing abroad and have a residence abroad, right? And what's that mean? That means that you have a home, right? So you might have bought a property that you live in, at least for most of the year, part of the year. You have a working visa, or I should say any sort of visa that allows you to stay more than a tourist visa. You could have a local bank account, local, even a library card, a gym membership, obviously maybe a driver's license or health insurance. And it really just, a number of factors that really shows that you are actually living in a country and establish residency there. That doesn't mean that you have to be in the country the whole, 365 days out of the year. In fact, the advantage of the bona fide residence test is the fact that you can go back to the United States for a few months out of the year and still qualify for this. But again, it's really just a number of factors that show your intent and show the fact that you've laid down some groundwork and actually establishing your residency outside the United States. Again, any sort of, if you're have any income from your country bona fide resident, if you're married or have family in that country, and really just, again, there's no sort of magic sauce when it comes to doing this. But if you have 3 or 4 sort of factors that show that you're in that country and living in that country, then that would qualify you to be a bona fide resident of that country. The other one is called the physical presence test. And what that means is literally you're just living outside the United States for 330 days in a 365-day period. And that could be a partial year exclusion. It doesn't have to be calendar year, right? So meaning that if you leave on July 1st of 2017 and you fast forward to July 1st of 2018, if you were abroad for 330 days in that 365-day period, meaning you were only in the States for 35 days, then you'd qualify, right? So you do kind of a pro rata exclusion on the 100,000 for the first half of the year, and then pro rata for the second half of the year where you were abroad through July 1st of 2018, right? So there's ways to play with it if you don't leave the U.S. on January 1st. It's also important to note that travel days do count. So if you did, let's say go in the U.S., if you were, let's say, traveling through the U.S. on a connection flight between South America to Europe, you were in the U.S. for that one day, so that counts. And it's also important to note that you should leave some cushion, because it is a very strict 35-day period. And let's say if your flight's delayed or anything were to happen where you had to stay a couple of extra days, that could obviously be a very costly mistake. It's also important to note, even if you left the U.S. but were still over U.S. airspace, that would count. So for example, let's say you were flying down to Mexico and your plane left Chicago at 11:30 p.m. You were still over U.S. airspace when the clock struck 12, and in fact, that would count as a travel day, just being over U.S. airspace. So it really, really is important to be aware of these days and count the days correctly, because like I said, it could be a costly mistake. The only other thing I do want to bring up is, whether you're a bona fide resident or whether you're qualifying for the physical presence test, any time that you spend working in the U.S. Counts as a working day. And again, you have to do a pro rata calculation, so that money would be taxable. So if you spend a week in the U.S. and you were working either at a conference or just at home or for a work trip, you would have to do that sort of pro rata, so that those 7 days would not count as far as the foreign earned income exclusion. But like I said, we could go into that a little bit later if anyone has any specific questions on that. Next is the foreign tax credit, and what that means is it's really a dollar for dollar credit on taxes that you pay to foreign governments. So again, if you let's say earned under the 100,000 threshold, but you lived in a high tax jurisdiction like Europe, then it might be better for you to take the foreign tax credit. And the reason being that if you are paying extremely high taxes, then of course all your European taxes would cover any sort of American tax liability, and you could potentially qualify for stuff like a child tax credit or even being able to contribute to your Roth IRA. And so it is sometimes important to do the analysis to make sure which one is more beneficial, depending on your tax situation. Of course, if you were earning passive income, like from interest or dividends from let's say foreign investments or foreign real estate, and you were paying local tax, then yes, you would be able to take the foreign tax credit on that income. And generally, obviously, a local government like Colombia, for example, would take a 30% withholding on any sort of dividends or interest income, and you would recognize that income on your U.S. tax return, and of course pay, or I should say, receive the foreign tax credit for the taxes paid to Colombia, and then pay any sort of subsequent U.S. tax if there was some. The next part is what's known as the foreign housing exclusion. Now, what this is this essentially levels the playing field for people that are paying a substantial amount of money in their rent, to kind of level the playing field with what you would pay in the United States. So in 2017, the foreign housing exclusion starts at $16,000, right? And what that means is if you're paying rent over that $16,000 amount, then anything over that amount you can add to the foreign earned income exclusion. And so to give an example, let's say your rent for the year was $25,000. And so because that 25 is over 16 by roughly 9,000, then you would add that 9,000 to your 102,000 exclusion. So your foreign earned income exclusion for the year would be 111,000. This foreign housing exclusion is generally capped at 30,000, meaning up to $30,000 in rent. But there's actually a lot of places that there's a higher cap, right? So there's a whole schedule that's provided by the IRS listing out different countries and cities. And as you could see there, Hong Kong is capped at at 114,000, and that's really the highest. So I have clients that are spending $60,000, $70,000 a year in rent in places like Hong Kong, London, Singapore, and so they're getting the 100,000 exclusion, 102,000, and then they're also getting roughly 50, 60,000 additional foreign housing exclusion on top of that, given some of the absurd rent prices in some of these places. The foreign housing deduction is again for self-employed expats. This allows people to deduct housing expenses from their gross income. So again, this also does limit the amount of tax you pay, given if you're self-employed and paying rent. Of course, people that own a house, they don't get this sort of rental exclusion, this foreign housing exclusion. Of course, they could still deduct any mortgage interest or property tax on their Schedule A, just like any person would living in the States, but they don't qualify for the foreign housing exclusion. And as you can see, it includes rent, utilities, any sort of property insurance, repairs, residential parking. These expenses all qualify for the foreign housing exclusion / deduction. But a lot of people generally ask, foreign earned income exclusion, what does that mean, right? I mean, and to be very clear, this is only for income that you earn for working, right? So anyone that's on a pension, anyone that's receiving passive income from rental properties or dividends, stocks, bonds, even someone that's a trader, that doesn't count. That's all considered passive income. However, if you were working, albeit as even a independent contractor doing side work, if you're working online, if you're working locally, but you're actually physically working in the place that you're living, which is of course outside the United States, then this qualifies for the foreign income exclusion. And so it's important to note that you actually have to physically be working. The other important thing to note is that it doesn't matter where the source of your income is, right? Meaning you could be working for a foreign company, you could be working for a U.S. company, you could be working for yourself, having U.S. clients, paying into a U.S. bank account. But because you're actually physically working abroad and you qualify for one of those two tests, right? Either the bona fide residence test or the physical presence test, and to be clear, it's either or, then you could qualify for the foreign income exclusion and exclude 102,000 foreign earned income. Quick note about people that have rental income. Sometimes we have taken the approach, if they're actively managing their real estate portfolio, that is earned income. And so, we've generally taken like a small management fee, let's say roughly 10%, something very fair, and excluded that income. So that's one thing. But again, you have to be actively managing it. You have to be actively working. But if you are doing that, that's of course something to think about. But one other thing is, again, if you're actively trading like a day trader, there are some very strict rules about that, and unfortunately that does not qualify as earned income under the current tax rules. So that wouldn't count. That would still be passive income. Another thing to really think about when you're thinking about the foreign earned income exclusion, or even foreign taxes paid and your foreign income from various investments abroad, is of course the exchange rate. And here in South America, the exchange rate could fluctuate quite a lot. I mean, Colombia has the last year or so, Brazil, Argentina. I mean, they've all fluctuated, and so you can do an analysis, if you will, and come up with the best exchange rate to use that year. And you have three options. One is the average exchange rate for the year, and actually the IRS can provide that for most countries. You can get the average exchange rate for the month, or you could even use the exchange rate for the day. And so, depending on your situation, some people either, had a big transaction like a home sale or a big bonus. And so it might be better to use, the monthly exchange rate or even the daily exchange rate as opposed to the yearly one. And so as long as you're consistent throughout the return, you're allowed to pick which one you could use. And by consistent, I mean, listen, if you go with the daily exchange rate, because of a big home sale, then you have to use that exchange rate every time you get paid from your job or every time you receive the dividend. You have to be consistent with that methodology throughout that year's tax return. Now, of course, the next year you could always do a different one, but again, it's all about consistently throughout that tax return of that year. The other big thing to note is being an expat or investing abroad is your foreign asset declarations. And the first declaration is what's known as the FBAR. And the FBAR stands for Foreign Bank Account Reporting. It's also known as FinCEN 114A. And really, it's straightforward. It really says if you have an aggregate balance of $10,000 at any point in time during the year, you must notify the IRS and file the FBAR. And what that means is if you have several accounts and again, their highest balance is combined over 10,000, then you have to file. And so let's say you have one account that in May, the highest balance is 6,000 and another account that in August, highest balance is 5,000. If you combine the total, it's 11,000. So it trips the limit, and then you have to file both those bank accounts. You have to disclose them. Now, of course, that doesn't mean that you have to pay any extra tax. I mean, obviously, if you earn interest income or dividends, you'd have to declare that and pay tax on that. But this is more of a declaration and reporting these financial bank accounts. And if you don't, there are some major fines, $10,000. But like I said, I mean, it's important to disclose it. Even if you had a big balance, some people get concerned because they might have, purchased a home and all of a sudden they transferred a large balance that was in their account for a couple of days before they did the transaction. Obviously, if there's a logical explanation, there's nothing to be worried about. And so this is more of, making sure that you're crossing your T's, dotting your I's, and doing this because the fines obviously are quite substantial. The other major form is what's known as the 8938 form. And this form does have some overlap with the FBAR, but also casts a wider net. And as you can see, the limits on the 8938 form are a lot higher. For living outside the United States, it's 200,000 if you're single, married, or married filing separately as of 12/31. If you're filing jointly, it's 400,000. And then living in the U.S., it's either 50,000 single or 100,000 married filing jointly. And so, as you can see, this form, other than the FBAR, which is filed separately, this form is included on your tax return, and hence you do want to make sure that you file this with the taxes, and you do want to make sure that you're aware of this. Now, like I said, it's a wider net, so it doesn't just include bank accounts, but also includes any other sort of foreign financial assets, right? So that could be, holding stock in a foreign company. That could be loans to a foreign person. It could be, foreign mutual funds, foreign pension funds. It can be any other sort of custodial or brokerage account, any sort of financial instrument. Would have to be declared on this form. Now, obviously, the other part of the question is, well, what don't I have to report? And the first one, which is the most important one, is foreign real estate. However, it has to be held in your own name. So if you buy a house in your name, that's not reportable. However, if you buy a house via foreign entity, right, via a trust, or a foreign company, and you see this a lot, obviously, in Panama, people buying it through foundations, or Costa Rica, et cetera, then by buying it in a foreign company, then you have to start reporting it. Then it does become a foreign financial asset. Any sort of physical gold bars or bullion, anything sold that's actually held in a vault that's physical, that has to be recorded. That does not have to be reported. If it's any sort of certificates like Perth Mint or gold money, something on paper, then you don't. So I mean, it's pretty simple. If it's something that you could hold in your hand, then you don't have to report it. But if it's something that you can put in a folder and is on paper, then you do. Of course, any sort of other tangible assets for investment like jewelry, cars, that's not reportable. A safe deposit box at a foreign bank is not reportable. And then finally, any sort of asset in the name of a foreign spouse, right? And that's, of course, if you're not filing jointly, if she's not being declared on your tax return. And so, that's a big thing for people that obviously, don't, have a foreign spouse that isn't American, to put these sort of assets and whatnot in that name, because that spouse doesn't have to report it. They don't have to report the income either. And so this is obviously a legitimate way to not have to report certain things by putting in your spouse. Of course, you want to have trust in your spouse. You don't want it to just be the new girlfriend you met last week. But if you do have that option, then of course, this is certainly something to explore. I want to go into the slide, but I want to touch base on it very briefly because I don't want people's head to explode. This is a lot to take in, but there's something called a PFIC. A PFIC stands for Passive Foreign Investment Company, and generally, an example of a PFIC would be a mutual fund or any sort of foreign corporation that owns passive investments. And the main takeaway from this slide is that if you are looking at PFICs, you're looking at foreign mutual funds or any of these foreign investments, you just want to make sure that it's not deemed a PFIC. By doing so, you don't have to deal with sort of the PFIC rules, which tax them at a higher rate, and you have to file another form called 8621. So I think this is more for people to be aware of this concept, to ask the right questions. Hey, is this considered a PFIC under the U.S. tax law? Hey, what is this? How do you file for this? I mean, because there are ways to avoid PFIC treatment. One is by making a check the box election, where rather than have a PFIC, people get a K1 that's issued to the U.S. investors. Another way is if you have a self-directed IRA, you could invest in these sort of PFICs, these foreign mutual funds, via the IRA, just because then the IRA is obviously not taxable, and then hence these PFICs aren't subject to the high tax treatment. So there's a few ways around it, but I think it's really important to to be aware of what PFICs are, and then of course avoid them or ask the right questions. The next slide really talks about foreign corporations, partnerships, and trusts. Now, as you might be aware, these all need to be filed and disclosed. And there's several different forms for each of these. So for a foreign corporation, you have to file Form 5471. And again, there are different categories depending on how much ownership you have, if it's over 50% or not, etc. For foreign partnerships, it's 8865, and then foreign trusts, it's 3528. But I think the real question, if you are going to open up any of these structures, is really what's the reason for that? Some people open up foreign companies to hold their foreign assets for estate tax protection or asset protection and estate planning. Of course, to avoid probate. If you have several offshore assets and you want to just put them in a foreign company to give to your kids when you pass on. There's also some really interesting tax structures for people that open up foreign companies and operate through them, right? And so, for expat entrepreneurs, that are operating their foreign companies from outside the United States, and they have or I should say, they have customers around the world. They have a team that's also outside the U.S. Then by opening up a foreign company, you can optimize your tax situation and achieve some really good tax advantages by paying yourself a salary up to the 100,000 foreign earned income exclusion, and not having to pay self-employment tax, right, which is roughly 15.3%, and that's essentially Social Security and Medicare. You could potentially achieve income tax deferment, although that changed with the new Trump tax laws, so that again, anyone that owns a foreign company would have to bring some of that money back onshore, but also nowadays the new structure would be where you would be able to pay a 10%, 10.5% corporate tax, which is still really, really good. If you operate from a foreign structure that's owned by a U.S. C Corp. And so I don't want to get into things too deep, because this is something that really just depends on each individual situation. But by operating these foreign companies, people can achieve certain tax advantages and optimization strategies, and like I said, asset protection. So it really is just depending on what people's needs are and their current situation. But this obviously could be helpful, and as long as you know about filing the U.S. forms for this should not be a problem. Also, just going back into tax filing, I mean, I think that people that are living abroad, they do need to file tax, but of course a lot of people don't know about that. And so there are some filing options for people that haven't filed their taxes in a while. One is called the Streamlined disclosure program, and again, that's for people that have been abroad for a while, over 3 years, and just didn't know about their tax filing requirements, right? So they're essentially a low compliance risk. And by applying for the Streamlined program, the IRS would review your submission and not assess penalties on this. I mean, this is pretty much the easiest, most straightforward program that I would say 99% of our clients have gone through because they didn't know about filing. The other one is called the Offshore Voluntary Disclosure Program. This program is actually about to end in the next few months. This one's for people that really were aware of not filing and voluntarily did not file, right? So they did have willful neglect. They did essentially commit some fraudulent activity. And by doing this program, there still would be penalties for not filing. However, it would avoid criminal prosecution, and people would have to file 6 to 8 years of back tax returns for not filing. And number 3 is what's known as the Quiet Disclosure Program, right? This is for people that are trying to quietly submit their returns and essentially just send it into the IRS without saying anything, and then of course hoping that the IRS doesn't do anything. And this is the option for some people that want to roll the dice and not go through the Streamlined program. Can certainly do this. Like I said, I mean, it's at your own risk, but I think that the point is that there are options for people that haven't filed in a while, that people that didn't know either about filing while they're living abroad, or even filing and just finding out now that they had to disclose for the FBAR or disclose for some of these foreign companies and foundations, etc. And people do have options. So although it does seem scary and there are fines, people do have options for ultimately disclosing and getting on the right track. The next thing I want to talk about is what's known as the 1031 exchange. This is well, starting in 2018, this is actually primarily only for real estate. Before it was for other property, but in the real estate context, which is what I usually work in it anyway, you're allowed to, if you have a rental property, you're allowed to sell that property and then within 6 months buy a new rental property and defer the capital gain on that. And so, by shifting, by shifting, your investment from one property to another, you do not have to pay tax. The one important thing to note is that if you own a property in the United States, a rental property, you can sell that property and do the 1031 on another U.S. property, but you can't take that money abroad. Likewise, if you have a rental property in a foreign country and you want to sell that rental property and buy elsewhere, you can sell that property and buy in another foreign country, but you can't do the 1031 exchange and go buy in the United States. And so it's either foreign to foreign or U.S. to U.S. But like I said, I mean, for real estate investors, it's a really good way to defer your capital gains by by potentially selling and rebuying elsewhere within 6 months. Next, just thinking about renunciation. I mean, this has obviously become an ever important and asked about topic, right? As people understand all the filing requirements and how FATCA has come around and made people file and report all their assets, and some people don't want to do that. So, renouncing U.S. citizenship, there are a few steps in the process. One is, of course, getting a second passport, whether you're living in a foreign country and eligible, or whether you end up, buying one, buying a citizenship. You do want a second passport in order to renounce. And obviously, in order to travel, you need another passport. As far as the process, though, you want to basically book a renunciation appointment with the embassy, and then prepare the questionnaire that's given by the embassy, which really just goes into your sort of background on being a citizen. And I think the most important part is them asking, why do you want to renounce? Of course, the answer to that is not because you want to avoid U.S. tax, right? You want to say something along the lines of the fact that you feel a closer connection to your country of residence. You don't go to the U.S. anymore. You don't have that connection. It's too tough to keep up with all the laws. And by doing so, it's a pretty straightforward process. Like I said, you go, you do your renunciation appointment, and then at your appointment, you talk and obviously tell them these reasons, a certificate of lost nationality. And then, of course, you do have to file your final U.S. tax return, and that would be from January 1st that year up through the day of expatriation. Now, if you do have any sort of U.S. source income after that, right, via rental property, via U.S. pension or Social Security, et cetera, then you still have to be filing a 1040NR, right, which is for non-residents. So you might not even get out of the full U.S. Tax filing if you do have U.S. or source income. But if not, then it is a matter of filing your final tax return and then being done with it. The other thing to note, of course, is if you're a covered expatriate, you have to pay an exit tax. And a covered expatriate meaning you have over $2 million or more of net worth, and essentially you would do a hypothetical sale of all your assets as of the date of expatriation. Excuse me. And you would pay a hypothetical capital gain on your assets worth over $2 million. So kind of a pro rata portion of all your different asset classes over $2 million. So it is of course a task of getting the value of all these assets. Some assets could be illiquid, like a house or maybe any private equity investments, but essentially you do a sale of these assets, and then of course pay an exit tax on the sale of these assets. So as everyone knows, the tax deadline is under a month away, and of course you do have to file your taxes by then, or pay an extension, or file an extension. And of course, if you owe tax, you need to pay by April 17th. So the extension is an extension to file, but not an extension to pay. So if you do owe tax, like I said, file, at least overpay, and then of course you get the refund or apply it to next year. The FBAR is also due the day that you owe the taxes, or that you file your tax return. And of course, if you extend your tax return, you extend the FBAR. If you are an expat, then you actually have an automatic extension to June 15th without doing anything. Again, you'd still have to pay if you owe by April 15th. And then of course, October 15th being the final U.S. deadline for people that file for an extension. So that being said, this is my contact details. If anyone wants a free consultation, feel free to email me directly. My email's there. Of course, there is go to the website to learn a little bit more about us. You could also sign up directly on the website for a free consultation, and either myself or one of my associates would be happy to help. So again, thank you for having me. I mean, I'll end up answering some questions, but in the meantime, please feel free to sign up, and we're happy to help.
Okay, perfect. So I don't know if you can see the questions there on your side, but what I'll do for everybody is I'll read the question out loud, and then if it pertains to Vincenzo, he'll answer. If it pertains to me, I'm happy to answer. And we do have about 10 minutes for questions. So we'll try to get through as much as we can, but I'm going to put Vincenzo's email address back up here on the screen, because if we don't get to one of the questions, please reach out to him directly, Vincenzo at onlinetaxman.com. Set up your free 30-minute consultation. As you're very aware, taxes are coming up. So if he touched upon anything that you have not yet done for your taxes, or you're not sure what to do, you will want to contact him in order to get your tax forms all tidy. So first question I'm seeing here is from Brenda. And she's asking, are travel expenses, looking at foreign investments, tax deductible in the year incurred? What about conference expenses?
Sure. So that really depends on the type of investment, right? So for example, if one travels for an investment that they make with their IRA, for example, the IRA is obviously tax-free. And so there's nothing to report on the tax return, in order to deduct that expense against, right? So whereas, in another case, let's say that, one invests, again, out of pocket, if you will, right, from their taxable savings account, if you, in a foreign real estate or any other sort of foreign land or farming, etc. And they're obviously listing the income and expenses on their tax return from that investment. Then that could be deductible, right? Because they're going down to a certain country. They've obviously invested in that country, and so as part of that investment, they had to do some due diligence, or even they had to come down to sign the final paperwork or meet with the lawyers, etc. And so that in that example, yes, a portion of those expenses could be deducted, or even all of them, right? I mean, I think the thing is, the IRS is very, very aware and pretty keen on making sure that people are strictly going down for business purposes. And so if you went down to conduct some business or conduct some investment, but then also stayed for the weekend and did something, obviously social or vacation, leisurely, if you will, then there would have to be sort of a proportion of the expenses that would be for business, and then a portion that would be for leisure, and then hence that wouldn't be deductible. So, I mean, there's no, it's a gray area, whatnot, but I mean, that's part of it. To answer the conference question, that's another area that the IRS is really, not too keen on letting people deduct conference expenses. Now, any sort of newsletters, either from LIO or Sovereign Man or any of these investment newsletters, et cetera, those are 100% deductible. That certainly is deductible. But sometimes conferences, again, if there's no investments made or anything like that, then that unfortunately, would be quite aggressive.
All right, very, very good. And the next question I have coming through, Marsha sent me an email that she wants me to read. So Marsha, give me a moment to find that email, and in the meantime, I'm going to ask another question to Vincenzo. All right, here's a good one. If I am writing a book while living overseas, working outside the USA, does this count as foreign earned income?
If you're writing a book, I mean, first off, again, it has to be something where you need to qualify for foreign earned income exclusion, right? So it's not like, oh, I took a vacation and I wrote a book, and then I went back to the United States, I started selling the book and whatnot. You know what I mean? So, I mean, first is you want to obviously make sure you qualify for the foreign earned income exclusion. But that being said, if you're writing a book and you received an advance on that book, or you received a piece of the royalties, the proceeds from that book, then yes, I mean, it would qualify. So I've had some clients that are writers, and yeah, we certainly exclude that income. They've gotten proceeds and advancements, and you wrote the book, etc. So yes, it would count.
Okay, perfect. I have another fellow here who said, can we get the slides? And Vincenzo, unless you object for any reason, I will send John the slides.
I'm happy to. Yes, that's fine.
Okay, perfect.
Happy to share.
And this one is, if an investment property is titled by foreign corporation with shares owned by myself as a trustee of my solo 401k trust, is this reportable, and how? I'll read it again. If an investment, sure. If an investment property is titled by foreign corporation with shares owned by myself as a trustee of my solo 401k trust, is this reportable, and how?
Well, I mean, if it's like a solo, well, normally solo 401k trusts, I think, are U.S., right? So I mean, again, if it's something where it's or I should say U.S. trust, then it's not reportable, right? But if it's a foreign trust, then that's reportable under Form 3528 for foreign trusts. So I mean, again, it kind of goes down into, and this is just kind of speaking about self-directed IRAs in general. Are they U.S. The U.S.-based self-directed IRAs, or are they foreign-based self-directed IRAs? I mean, the self-directed IRA could obviously own foreign assets, but if it's in the U.S., then it's not reportable. But if it's, of course, abroad, then it will be reportable. So that's kind of the general rule of thumb.
Okay, perfect. This one says, I have purchased 2 rental condos in Mexico. I have not received title to either property, it's new construction, until the condo regime is finalized. What can I deduct for furnishings and travel expenses?
Well, again, I mean, if you've gotten, if you've held, if you have the asset, and you have furniture that you purchased, then that's something that essentially, once you start renting out that condo, you you could start depreciating it, right? So furniture, like a rental property, is subject to depreciation, right? So you could kind of expense it over furniture is generally 5 years. So you could start depreciating it, but the thing is, you really can only start depreciating something when it's available for rental. And so you would just hold on to the furniture, and again, once you have title, once it's available for rental, then that's when you could start deducting expenses. So again, furniture or even travel for that matter. So I mean, I would just say to quote unquote wait until you have title, and until it's kind of the year where you're able to kind of actively market the rental property. Even if, let's say, the first month or two you're still furnishing it or whatnot. I mean, if you're still kind of actively marketing that property, then you could start depreciating it, and then you could start expensing things.
And Vincenzo, that prompts a question for me to ask you, which is because I'm in Belize and I understand how long titles can take here. Titles can take a couple of years. Panama can take a couple of years. And if somebody has a condo or a home that's already constructed and they have a purchase agreement with the seller, can they use that in lieu of having the title? Because title can take a long time to physically produce.
Sure. I mean, I think it's more the facts and circumstances of one situation.
Sure.
So if someone's taken possession, they have the purchase agreement, and they're actively renting it, they're actively managing it, etc., then I would say that would take precedent over just having a title for something, and
Right.
So yeah, it's more of the circumstances of, okay, have they taken possession of it, even though technically it's not titled in their name. If they've taken a possession, they've started living in it or renting it out and receiving that income, then that would constitute again, being able to deduct these expenses, or obviously declare it on their tax return.
Okay, good stuff. And one from my neighbor here in Belize, Glenn. So Glenn says, I own property in Belize, have a work permit, a social security card, and certain Belize licenses. I am not a resident. I plan to stay here full time, so I am bona fide and thus eligible for foreign earned income exclusion for 2018 tax year. That was a question. I plan to stay here full time. And then, so he goes, so am I bona fide and thus eligible for the foreign earned income exclusion for the 2018 tax year?
I mean, it seems like obviously, given the facts and circumstances, having a driver's license and living there and having that sort of commitment to live there, then yes. I mean, visas is certainly an important one, but I wouldn't say it's a must-have, right? I mean, I have had to file people with tourist visas, but we've had family and kids locally and whatever, and obviously sometimes immigration can take a long time. And so I think it's more about other facts and circumstances, one's intention, to stay there, et cetera. And that's what qualifies for what's, bona fide residency in the foreign and income exclusion. And like I'll reiterate, it has to be earned income. So he has to actually physically be working there. It can't be him just as a retiree or pensioner just earning pension. That wouldn't count as earned income, and that would be excluded.
Right. Okay, so we have a lot more questions here, but I'm going to just ask you one more. And if we didn't get to it tonight, please just email Vincenzo directly, vincenzo@onlinetaxman.com. He'll schedule with you and his associates a 30-minute consultation to be able to go through your situation a little bit more specifically. But I do want to get this one last question in. I know it's getting late over there in Colombia, but James asks, what is the best way to get valuations for overseas properties that are held in a self-directed IRA?
Yeah, I mean, this is something that comes up a lot. Generally speaking, as long as you have some sort of local, broker or real estate person sign off on it, that would be fine. Yeah, I mean, this kind of comes up a lot just in general, because every year anyone who has a self-directed IRA, you have to quote unquote value the assets in it. in a lot of these investments, even some of the longer term investments like the Teak investments or what have you, we generally invest, or we generally value them at cost, right? Meaning how much they invested in it, unless there was any sort of, big transaction or, like another fundraising round or whatnot that would, that was at a higher valuation. So yeah, that being said, I don't think, yeah, I mean, I think real estate is a little bit different, but you could just kind of have someone local who knows the field sign off on that, or I should say at least value it, and then you would just need someone like a CPA. I mean, I've done it a lot for people, sign off on that valuation for the IRA custodian.
Okay, yeah, that sounds good. And I'm seeing about 25, 30 more questions come through here. So please, if you had something specific you want to ask Vincenzo, please reach out to him directly. Vincenzo, thank you so much for your time tonight. I know that you're really in the heart of tax season right now, so I appreciate, and I think I speak for everyone on the line when I say that we appreciate your time tonight. And I'm sure you'll be getting a few emails after this. So everybody have a really good night. And Vincenzo, thank you again.
Thank you so much. Have a wonderful evening. I appreciate having you guys.
Good night, everyone.
All right, cheers.